Banks in the United States have more than $23 trillion in deposits, and roughly 94% of American adults have some form of a bank account. Banks are important for the economy because they give out credit, which is essential for growth. They connect lenders with people and businesses who need money, and use the deposits they hold to fund the economy. However, banks can fail like any other institution. Since 2001, over 550 banks have collapsed, except for year 2005, which was the first year in American history with no bank failures. The collapse of some banks like Silicon Valley Bank, Signature Bank, and Credit Suisse has reminded us that trusted institutions can fail and risk billions of dollars. Normally, there are three main risk factors that can push banks into the risk of collapse: credit risk, interest rate risk, and liquidity risk. When these risk factors impact the bank's liquidity or solvency, bank failures become a possibility. Solvency means a bank's ability to meet its long-term financial obligations and debt. Banks make money by bringing deposits in and then lending that money out, hoping to collect those loans back with interest. However, if the loans go bad and the bank is unable to collect them, it can cause the bank to fail. The largest bank to collapse in American history was Washington Mutual, which failed due to insolvency during the 2008 financial crisis. Liquidity refers to how much money banks have to meet their short-term financial obligations. When banks have a crunch, depositors want their money immediately, but banks may have more demands for that immediate money than they have assets that they can liquidate to get people their money, leading to a crisis of liquidity. Silicon Valley Bank became the second largest bank to fail in American history due to liquidity issues. SVB bought many long-term securities yielding very low interest rates. But when interest rates rose, the securities lost their value. People became afraid that SVB didn't have enough money, so they wanted to take their money out of the bank. This caused a run on the bank and it failed. When a bank fails, the Federal Deposit Insurance Corporation (FDIC) steps in to protect depositors and improve trust in the American banking system. FDIC tries to sell the failed bank to another bank, or takes possession of the bank and creates a bridge bank to liquidate it. Depositors in FDIC-insured banks are covered up to $250,000 per depositor per bank. Swift action from the government is vital to contain bank failures that could lead to a domino effect and impact the economy. However, the federal government made a controversial move by announcing that all depositors of SVB, including more than 95% who were uninsured, would continue to have access to their money. Unfortunately, this could set a precedent for unlimited government support for every dollar in the banking system, which needs to be addressed in a rather comprehensive way. Remember the 2008 financial crisis when some big banks failed? This caused the economy to become weaker because banks started to lend less money. This makes it harder for people to borrow money and slows down the economy, sometimes causing recessions. Some people wonder if there are enough rules in place to prevent banks from failing. But the real question is whether the rules are being enforced correctly. It turns out that regulators were not doing a good job of watching some banks which collapsed recently. This failure shows that deregulation, that is making fewer rules, can be dangerous. It's a good idea to check if your bank is doing well financially, especially if you have more than the insured amount of money in it. If you're just saving money, you might want to spread it out across different banks for peace of mind. If something happens to a small community bank you're using, it's unlikely that regulators will guarantee all your deposits, only up to $250,000. If you like this quick explanation, please give it a thumbs up and subscribe for more videos about managing your finances.